We're back on Morning Trade Live. Let's take a closer look at the weight loss drug trade. Novo Nordisk and Eli Lilly have gone in opposite directions over the last 12 months, with Lilly gaining market share in the GLP-1 space and Novo Nordisk undergoing some changes in the C-suite. Novo is down more than 45% year over year, while Lilly is trading 9% off its all-time highs after a strong earnings report. All right, quite a divergence there, I should say. I'm getting those words mixed up this morning, but let's go inside out on the weight loss drug trade. As I mentioned, joining us now is Scott Zari, Healthcare Director, S&P Global Ratings. So we've seen the tale of two corporates this week with what we heard from Lilly and also Novo. Just talk to us about this momentum entrenched in Eli Lilly with, obviously Mounjaro and Zepbound, and what you took away from these earnings.
Sure. Well, first of all, thanks for having me on. I think every time I'm talking to you guys, I'm saying the same thing about Lilly. They had another great quarter. Revenue was up 40%. They guided to over 80 billion in revenue for next year. Both of those were way above expectations, and it really just demonstrates that the competitive position around their GLP-1 franchise is strengthening. And to your point about Novo, Novo guided to actual revenue declines in 2026. So when we think about, we previously described this as a two-horse race with Lilly kind of taking the lead, but I think now we've crossed a point where Lilly is not just taking a lead, they're dominating this market.
Yeah, I mean, it's not even a race anymore. I mean, that horse is going in the opposite direction around the racetrack at the moment. But look, at the end of the day, Novo beat Lilly to the market with that pill. But they are both facing price pressures as far as the intensifying price war for these weight loss drugs. What is Eli Lilly doing that Novo's not?
So, when we think about the pill, I think Novo didn't just beat them on the pill. They actually beat them first to market with Wegovy as well. But efficacy is really the main driver of performance in this market. And right now, Zepbound is the most effective, Zepbound, Mounjaro, whatever you want to call it, it is the most effective product on the market. And it doesn't really appear as if anything in development in the near term is going to change that. So, while the pill is important and it's going to expand access, and we kind of view it as more of a complement to the GLP-1 portfolio, and those injectables are still going to be the main driver of performance. So yes, Novo is going to be first to market again on the pill. Lilly's pill is, waiting for approval, and we think it will, also be successful. But as long as Lilly has the best injectable, that's going to continue to drive the outperformance.
Yeah, look, David Ricks made a really interesting point, and I thought it was just interesting as far as a stat is concerned. I mean, the fact that the pill is bringing new people and more people into this market that perhaps hadn't done the injectables before. He was saying, in fact, 8 out of 10 people are new to the GLP market, which I find is a fascinating trend here. Also, how people are actually paying out of pocket for this stuff. So they're choosing to have a healthier lifestyle. They're choosing to lose weight with their own money as well. Eli Lilly talked about a number of factors that they're going to continue to benefit from in 2026. Medicare coverage, demand for its drugs, etc. Do you foresee any challenges or risks here?
For us, I think a lot of the reimbursement is improving. They are going to have Medicare coverage. The deal they signed with the administration is a positive, and I think that's going to ease a lot of the legislative concerns and provide more access to these GLP-1 drugs. For us, we have Eli Lilly on positive outlook. What we're really looking for is, clearly the revenue growth is going to be strong. Cash flow is going to be strong. They're investing heavily in manufacturing. They have to finance that with new debt, or they have financed it with new debt. But they're going to get to a point where eventually the cash flow is going to be so robust that there's really nothing to do with it other than for debt leverage to come down. However, the one key risk to all of that is M&A. Pharma has a history of M&A. Eli Lilly has a history of a more conservative track record on M&A, but they've never really had this type of, windfall performance before. So what they decide to do and what their financial policy is going forward around M&A is probably the biggest risk to credit metrics. But assuming there's nothing large scale, there's really nowhere to go but down for financial leverage.
Okay. Scott, Scott Zari, we have to wrap it up there, but really appreciate your insights today on what is playing out in this weight loss drug trade. That is the Healthcare Director, S&P Global Ratings. Appreciate your time. Let's move on and trade it now with Tom White, host of Fast Market. So obviously we're seeing shares under pressure today, but as we mentioned, it's been quite a divergence between these two names. Just give us an example trade for Eli Lilly today, Tom.
Yeah, Eli Lilly continues to dig into that market share from Novo Nordisk, even though they're first to market in the GLP-1 injectables and now with the pill. And now you've got a little bit of consternation here today due to the fact that him and hers came out with, a new pill that costs less than Novo Nordisk, although they did just come out with a statement on that. But the stock's done pretty well, up about 23% over the last year. It's pulled back about 9% from those recent all-time highs after that pretty good earnings report here as their margins continue to expand. So I looked at something that you can still take a directional bias on this stock, even though it's run up so far, but giving yourself better probabilities of success. So I went out to the February 20th monthly options that expire in 15 days, and I'm looking at a neutral to bullish short put vertical here, where I'm going to sell the 990 strike put out of the money to the downside by over 30 bucks, and then against it by the 970 strike put. So short $20 wide, neutral to bullish put vertical. You're collecting. I've got a $5 credit on here. That's where it was trading earlier. It's trading closer to $6 right now, so you can collect a little bit more option premium. But that premium you collect, the credit you collect is going to be your profitability on this one. So you can make up to $500-600 on this trade with about $1,400 in risk, but that's all the way below the 970 level on this type of trade. You've got a probability that short 990 strike will be out of the money at expiration of about 65%. So you're giving yourself that better probability of success. That's the trade-off when you're risking more to make a little bit less on this one. That break even on this one about 985, that's about 4% below the current share price. So got better probabilities of success. You got a cushion to the downside, and you need the stock to either go higher, stay here, or go lower, just stay above that 985 break even.
Okay, thank you so much for that, Tom White. As always, an example trade on Eli Lilly for us this morning.